Earlier today, the yield on the 30-year U.S. Treasury got above 3% for the first time since April of 2019. Now, we didn't close above 3%. We closed at 2.99. The intraday high was 3.018. Now, the 10-year didn't make it up to 3%, but it closed above 2.9%. This is the high for this move. We're at 2.913 on the 10-year. By the way, the yield curve is not inverted anymore. The further out you go, the higher yields are, although the separation is still very narrow. And though I have been talking about the inversions of these yield curves and have speculated that we may actually get a complete inversion all the way from the 2s to the 30s, we haven't had that yet. And if it does happen, I think it's an aberration. I think it's a head fake, because the only reason we don't have a much bigger positive slope in the yield curve is because everybody believes that we're headed for a recession. Recession means that not only will the Fed slash interest rates, but that it also means an end to inflation. The market has this completely wrong. As a matter of fact, the last time 30-year Treasury yields were at 3%, which again was April in 2019. If you look at what the inflation rate was, the year-over-year increase in CPI, it was 1.8%. So that means when 30-year Treasury yields were 3%, you at least got a 1.2% real yield above the current 12-month year-over-year inflation rate. And also, by the way, inflation was trending down because earlier in the year and later in 2018, we had inflation prints year over year that were north of 2%. So inflation was already coming down when yields were above 3%. Fast forward to today, when we finally have 3% 30-year yields again, but the year-over-year increase in the CPI is 8.5%. But it's also 8.5% and rising, not 1.8% and falling. But that also means that rather than having 1.2% positive real interest rates, we have minus 5.5% of negative real interest rates. Now, of course, the actual rate of negative interest rates is much greater because the real inflation rate is much higher than 8.5. Now, that was also the case back in April of 2019 when we were reporting a inflation rate of 1.8. It was probably closer to 5% even back then, which meant we had negative real yields back in 2019, but they're just much more negative now. But if you accept the government's BS version of inflation, we had 1.2% real rates in April of 2019. Well, in order to have 1.2% real rates now, the yield on the 30-year U.S. Treasury has to go to 9.7%. Now, nobody thinks a yield like that is even possible, let alone probable. And I think that's one of the reasons that we actually had a 500-point rally in the Dow Jones today, even with new highs in Treasury yields. And the S&P 500 had an even bigger move. It was up over 70 points, 1.61%. The Dow's move was 1.45%. The Nasdaq also had a decent day, up better than 1%, 1.2%. But the very speculative stocks like Cathie Wood, ARK Innovation, that fund was up just over 4% on the day. And I think one of the reasons that you had so much enthusiasm for the stock market, despite the rise in yields, is because everybody is talking about the increase coming to an end, that we've already seen peak inflation, and this is about as high as interest rates are going to go. After all, about 3% is where we topped out in the past, and so we're probably topping out there now. Now, first of all, a lot of the analysts who are proclaiming that 3% is the high never thought yields would get to 3% in the first place. Most of the analysts, so-called experts out there, had figured that the yields would top out somewhere below 2.5%. So the fact that they got to 3% is already something that none of these guys expected. And now that it's happened, they're convinced that this is the top. Well, as I just mentioned, if rates topped out at 1.2% real in 2019, why would they top out at negative 5.5 now? Why wouldn't investors similarly demand a real return on their money when they're making a 30-year loan? Why would they be content to accept 5.5% losses for the next 30 years? Now, obviously, they're not going to do that. So to the extent that anybody is buying a 30-year treasury, they expect inflation to quickly move back down below 2%. But there is no indication that that would be the case. In fact, all of the information that's out there would suggest that inflation is going to continue to get worse. And even if it does improve, it's not going to go anywhere near the 1.8% it was in April of 2018. We'll probably never even see 2%. I don't even know that we'll even see 4% on any point year over year. Going forward, we're going to have much higher inflation for the rest of this decade than we had in the prior decade. And it was that extra low inflation that was the only reason the Fed was able to keep interest rates as low as they were. But given a much higher inflationary environment that we're going to be living in the future, there's no way that interest rates can stay this low. And so the markets are completely wrong in taking comfort in the fact that they think rates have peaked. We're just getting started. Yield on a 30-year bond is headed to 4%, then 5%, and it's going to keep on rising. Again, the only thing that's going to stop that is going to be a Fed pivot on rate hikes and a return to quantitative easing, even though quantitative easing hasn't even ended yet because the balance sheet is still expanding. In theory, they're going to start contracting the balance sheet in May. Well, the only way to stop bond yields from rising, at least in the short run, would be to do more QE, but nobody is talking about that now. Not even the biggest doves on the FOMC are talking about returning to QE. In fact, yesterday in an interview with Jim Bullard, he was talking about getting rates up to 3.5% on the Fed funds by the end of this year. Remember, we're at 0.25% right now. The range is 0.25 to 0.5, and Bullard is talking about 3.5 by the end of the year. And we're already well into the second quarter, so that's a lot of hikes. Bullard was talking about not ruling out 75 basis point rate hikes, let alone 50 basis point rate hikes. So when the Fed is talking about these type of rate hikes, there is nothing to stop the bond market from falling. And if Bullard is correct, and they actually get the Fed funds up to 3.5% by the end of the year, where do you think the yield on a 30-year treasury is going to be? It's not going to be 3%. It'll be at least 5.5%. And if 30-year treasury yields are 5.5%, where do you think mortgage yields are going to be? They're probably at a new high today. They might be at around 5.25 right now. I haven't seen them, but they were 5.15 yesterday, and that was before today's increase. But if we're 225 basis points above the 30-year bond yield, and 30-year bond yields are 5.5, you're talking about around an 8% mortgage rate. How are consumers going to afford to pay 8% mortgage? How are all the people with these adjustable rate mortgages that are going to be resetting over the next year going to afford to make the payments when you have this big an increase in interest rates? They're not. They're going to have to be cutting back their spending everywhere they can. The entire economy that is levered to the hilt is going to have to cut back dramatically on everything in an inflationary, rising interest rate environment, which is why this economy is headed into recession. And not just a shallow recession, but a severe, deep recession, which is why all these rate hikes aren't actually going to come to fruition, because the Fed is going to have to reverse course once it understands just how badly the economy is going to respond to just the talk of raising interest rates, let alone what would happen when the Fed actually gets around to doing it.